Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at ANET, or Arista Networks, Inc. ANET is engaged in providing cloud networking solutions for data centers and cloud computing environments. Here's the barchart.com technical opinion rating for ANET. The bar chart rating is a 100% buy, with a weakening short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that ANET is well above the moving average line, so the monthly trend in ANET is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green lines since the chart started, so the daily trend in ANET is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. ANET is near the midline of the Keltner channel, so ANET is inside the buy zone. Since the trend is up, we want to buy a call. ANET has plenty of option chains to choose from. We're going to use the November 3rd option chain. Right now, the November 3rd options have 18 days to expiration. Here's part of the ANET option chain for November 3rd. ANET closed at 89.85 on Friday. That means any calls on the list from 140 to 185 are in the money. Let's take a look at the profit potential for purchasing the 190 strike call. That is the ANET No 3 190 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 190 call is 10.30 to 11. We try to enter at the midpoint, so we'll use 10.65 as the buy price. Our call option calculator shows the profit potential for this call based on ANET price changes at option expiration from flat to a 12.5% increase in price. We can see that if the ANET stock price is flat at 189.85 at option expiration, the 190 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 170 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 170 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the ANET stock price is up 1%, the 170 call will lose 9% of its value. We want that to be break even or better, so the 170 call does not meet our requirements. Let's see if the 150 call will work. The bid-ask spread for the 150 call is 40.80 to 42.30. We try to enter at the midpoint, so we'll use 41.55 as the buy price. The 150 call works. If the ANET stock price is up 1%, excuse me, the 150 call will make a 0.5% or $20 profit. That's better than break even, so the 150 call is the one we'll buy. The call option purchase calculator also shows that if the ANET stock price increases by 2.5%, the 150 call will make a 7.3% or $305 profit. If the ANET stock price increases by 5%, the 150 call will make an 18.8% or $779 profit. If the ANET stock price increases by 7.5%, the 150 call will make a 30.2% or $1,254 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the ANET stock price does not make the expected move up and remains flat at expiration, the 150 call would only lose minus 4.1% or minus $170 compared to the minus 100% or minus $1,065 loss for the 190 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the ANET November 3rd 160 strike call and sell to open the ANET November 3rd 170 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 160 call for $31.95 and sell the 170 call for $23.90. $31.95 minus $23.90 equals $805. So the entry price or debit cost for the spread is $805. The call option spread analysis calculator picture shows that the spread will make a 24.2% or $195 profit if the ANET stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect a $2,390 cash credit to our brokerage account for the sale of the 170 call. As we said on the previous slide, this reduces the cost of entering the spread to $805. Here's a note regarding earnings reports. The next ANET earnings report is scheduled for October 30. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the ANET November 3rd 150 strike call for $41.55. We also reviewed the spread. The spread said to buy to open the ANET November 3rd 160 strike call and sell to open the ANET November 3rd 170 strike call at a debit of $805. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.